Let's get into our next segment here. We're going to bring in Joe Mazzola, head trading and derivative strategist here at Charles Schwab. Joe, I wanted to get your impact here of markets. We're on a 5-session win streak. If we can close positive today, pretty healthy snapback rally. I mean, are you a believer in this, or should we just kind of ignore that volatility that we saw earlier in the month? And hey, it seems like it's just risk-on trading again.
Can it be both, right? Can you believe in the fact that the market breadth is improving? You're seeing a lot of cyclical undercurrents in terms of where the expansion is. So, financials are doing well, materials are doing well. You're seeing quite a bit of buying below the surface. So it's not just a tech rally. Yes, you can make the case that semiconductors are up 8%. From last week, but so is the small caps, Tom. So I mean, there's money flowing into these sectors, and it's not just the narrow rally. Now, that being said, we've seen this before, right? Where people have been willing to say, okay, well, here's where you really want to get in front of the Russell and buy up all the small caps. So let's kind of talk about maybe what has predicated the move. It's the expectations of the rate cut, man. So when you're talking about something like the Russell, where you have small caps that, these are companies that are not very profitable. 40% of the Russell is not profitable, and you're borrowing at a short-term rate, and you see the potential for short-term rates going down. Those companies become a little bit more attractive in the short term or in the interim. And I think that's part of what you're seeing. But I think there's as you mentioned, Tom, there's a bit of a kind of this risk on sentiment, that we've held a couple levels, and now we're getting a bit of a bounce back. And whether or not it's a Santa Claus rally, we'll see, because things have been, kind of pushed back a little bit. But I think the other thing, Tom, is too, it's just not a normal market cycle with all the different things going on with the government shutdown. So I don't think you can just kind of go back to history and say, yep, Santa Claus rally starting right now, because there's a lot of different factors.
Yeah, and it seems like, Joe, and just from my, view of the markets at this point, there's a lot of bifurcation, right? You've got consumer sentiment, consumer confidence numbers way down. But then they just had, Thanksgiving Day spending up 5.3% according to Adobe Analytics. And then, the Fed rate cut cycle, that's helping support equities. But then you've got 3% inflation that the Fed's kind of fighting at this point. But at the end of the day, Joe, it feels like equities are still going to be the winners in this because of all the turmoil that we've had, whether you mentioned it, the government shutdown, the tariffs, headwinds. Earnings have been great, Joe. So that's kind of what, that investors doing. They're just sticking to the narratives that make risk on asset trading more popular, right? And that, hey, we can get supported. We've got all these outside, things that are kind of headwinds for the markets. But at the same time, when you got a lot of, assets and capital on the sidelines, hey, earnings are great, right, Joe?
Tom, I think you bring up a great point. Remember, when there's all this noise out there and you're getting all these mixed signals, whether it's, breadth signals or, what you're kind of hearing from all the different sentiment measures out there, ultimately, at some point, it comes back to the fundamentals. And I truly believe that. And we came off a really strong earnings season, about 83% beat rates and earnings per share. And the revenue side was much higher than we've seen in a long time, in the high 60% on the revenue beats. And expectations for 2026 have actually gone up, which is interesting as well. So, there's still a lot of high expectations for what the earnings cycle can be in Q4 and beyond. And I think, when you start pairing that with what you saw on the charts, where, dip buyers continue to step in, and we see that not only from the technical perspective, but we also see it from, some of the measurements that we look at here at Charles Schwab, and that's our stacks measurement. When we looked at the end of October, that final week of October was some of the heaviest buying that we've seen all year. And some of that has carried forward. It's been a little bit more choppy in November, and that's, I'm assuming that's kind of expected given what we've seen. But for the most part, when we have seen pullbacks 3%, 4%, 5%, investors have been willing to step in. That has not changed. And a couple of things, from the options market that I just noticed there recently, Tom, as well too. Some of that hedging that's kind of pulled off from the S&P 500 that was more institutional led. You're starting to see more and more kind of upside call buying in the semiconductor index, showing you that at least at this point right now, there's belief that there's more upside to the tech rally.
Yeah, and you bring up a good point about the retail side of trading. You guys track that quite a bit. Is the fact that, hey, retail trading and retail investors were the ones buying in April. It wasn't hedge funds, it wasn't institutions, and they're buying dips now. We've seen that over the last 4 or 5 trading sessions. They're buying this November dip. So, hey, retail is smart money at this point so far here in 2025, Joe. But looking ahead to next week, anything sticking out that that might throw a wrench into this rally or actually help support it as far as maybe data earnings?
Sure. Well, I mean, look, we're still catching up with the data, right? So next week, we're going to get the ISM manufacturing, ISM services. I think both of those are going to be important. We're going to get the Challenger job cuts for November. These are some private sector data points that are coming out that the markets are going to be trading off of likely. We get things like PCE. So, as we're as you mentioned, Tom, looking at 3% inflation, the Fed prefers to look at the PCE, but this is the September data, so it'll be lagging. So you're going to have to kind of, mix that in and maybe throw different probabilities on that while we're still waiting for the October data. But we're starting to get that data to kind of to flow back in. The other thing I'd be kind of paying attention to as well is some of the different earnings that we have in Marvell, CrowdStrike. There's still some relatively large market cap weighted names that are releasing next week that could be market moving. And then, as you mentioned, sentiment. So we get the University of Michigan consumer sentiment number. So yeah, a good amount of data next week for markets to focus on.
Yeah, and they're going to be focused on the consumer. It's Black Friday, Joe. We got to close these markets so I can get online, start shopping at this point. All right, Joe, great stuff.
You're not running. You're not going to be running into the stores, I'm hoping, right?
There you go. Maybe. All right, thanks, Joe. I appreciate it. That's Joe Mazzola, head of trading and derivative strategist at Charles Schwab.